Have you ever felt like you're doing everything right with your money, but somehow you're still stuck? You read the headlines, you check the stock market, maybe you even bought a little crypto because somebody told you it was going to the moon. And yet, you open your credit card statement and you feel that drop in your stomach, that heavy feeling, like no matter how hard you try, you're still not moving forward. If that sounds familiar, you are not broken. You are just using the wrong order. Because here is the truth most finance gurus never say out loud. Most people are pouring money into their financial bucket while the bucket is full of holes. They are buying stocks, chasing trends, trying to invest like the rich, while high-interest debt is sitting in the background, quietly eating them alive. That is not wealth building. That is financial leakage. And today, we fix it. Because there is a step-by-step sequence to building real wealth, a real order, a real system. The kind of system disciplined savers use to stop guessing, stop reacting, and start building. Follow this order, and your money starts working together. Ignore this order, and you're building your financial future on quicksand. So let's do this the right way. Step 1. Before the hot stocks, before the crypto, before the big investing dreams, we build the thing that lets you sleep at night. Your emergency fund. I know, not sexy, not exciting. Nobody brags to their friends that they finally put cash into a savings account. But this is the foundation. This is the concrete under the house, because life is not a straight line. Your car breaks down, your water heater dies, your dog gets sick, your hours get cut, your job disappears. And if you do not have cash, you do not have options. You have stress, you have panic, you have bad decisions made under pressure. And that is exactly how people end up swiping a credit card or selling investments at the worst possible moment just to survive one ugly week. So your first mission is simple. Get your first $1,000 saved as fast as possible. Not perfect, not fancy, not invested, saved. Then build that into 1 full month of expenses, and eventually 3 to 6 months. Because when you have cash in the bank, something powerful happens. You breathe differently. A surprise bill stops feeling like a life crisis and starts feeling like an inconvenience. That matters a lot. Because personal finance is not just math, it's behavior, it's emotion. It's what you do when real life punches you in the face on a Tuesday afternoon. And if you have a cash buffer, you stop making desperate money decisions. Now, once you have that first layer of protection, we move to the next enemy. And this one is brutal. High-interest debt, credit card debt, personal loan debt, anything charging you the kind of interest that makes your money bleed. Let me say this clearly. If you are paying 22% interest on credit card debt while hoping to earn 8% in the stock market, you are not investing. You are running uphill in a backpack full of rocks. Every extra dollar you throw at that debt is a guaranteed win, a guaranteed return. No hype, no guessing, no praying the market has a good month. Just progress, real progress. Because paying off 22% debt is like earning 22% on your money without taking market risk. That's huge. And this is where a lot of people mess up. They want to feel like investors, so they ignore the debt. They want the excitement, so they skip the cleanup. But wealth is not built by pretending the mess isn't there. Wealth is built by facing it, by getting aggressive, by cutting the rate of financial bleeding first. But there is one exception, and this is a big one. Before you throw every dollar at that debt, check your job. Does your employer offer a 401k match? Because if they do, that changes the math. That match is free money, literal free money. It's one of the only moments in life where somebody says, if you put in $1, I will give you another $1. That's a 100% return immediately. So even if you have high interest debt, you still want to contribute enough to get the full employer match. Not more than that yet, just enough to capture every matching dollar. because walking away from a 401k match is like refusing part of your paycheck. So let's make the order crystal clear. First, small emergency buffer. Then, grab the full employer match. Then, go hard at the high-interest debt. That right there changes lives. And once the match is secured and the toxic debt is gone, now we enter the zone where real wealth starts to accelerate, the tax optimization zone. This is where a lot of people automatically keep dumping money into their work 401k, and sometimes that's fine, but not always. Because some workplace plans are loaded with expensive funds, high fees, limited choices, and all kinds of little wealth-eating termites you don't notice until years later. So before you blindly keep feeding that account, look at an IRA, an individual retirement account. It gives you control. More control over what you buy, more control over fees, more control over your long-term strategy. And that control matters. Because over decades, even small fees quietly steal massive amounts of wealth. With an IRA, you can often choose simple, low-cost index funds, where more of your money stays yours. And for 2026, you can contribute up to $7,500 or $8,650 if you're age 50 or older. Now, the next question is, traditional or Roth? Traditional gives you the tax break now. Roth asks you to pay the tax now so the money can grow and come out tax-free later. And for a lot of beginners, especially younger earners, the Roth is incredibly attractive because you're basically handling the tax bill up front and giving future you one less problem to deal with in retirement. That is powerful. And now we get to the account almost nobody talks about enough. The secret weapon, the financial Swiss Army knife, the HSA, the health savings account. This account is a monster in the best possible way because it gives you something almost no other account gives you, a triple tax advantage. You may get a tax deduction going in, the money can grow tax-free, and if you use it for qualified medical expenses, it comes out tax-free. That is rare, very rare. And if you're eligible for an HSA, you should pay attention here. For 2026, you can contribute up to $4,400 for self-only coverage, or $8,750 for family coverage, with an extra catch-up contribution if you're 55 or older. But here's the real pro move, and this is the part most people miss. You can pay medical expenses out of pocket today, save the receipt, leave the HSA invested, and reimburse yourself years later. That means the money has more time to grow while you keep a future tax-free withdrawal sitting in your back pocket. That is not just smart, that is strategic. Because healthcare and retirement is expensive, not a little expensive, potentially 6 figures expensive over time. So, if you qualify for an HSA, do not overlook it. This account is not boring. This account is a weapon. Quick pause here. If this video is already changing the way you think about money, hit subscribe because this next part is where people separate from the pack. Once the emergency fund is in place, the employer match is captured, the high-interest debt is gone, the IRA is funded, and the HSA is working for you, now you go back to the 401k and you push harder. This is where you try to max it out. For 2026, that means up to $24,500 per year, not counting catch-up contributions if you qualify. Why now? Because now your foundation is strong. Now your cash cushion exists. Now the toxic debt is not dragging you backward. Now every extra dollar you invest has a cleaner path to compound. And that is the whole point. Not movement, progress. Clean progress. And only after you have filled these tax advantage buckets, only then do we talk about a regular taxable brokerage account. And I know that sounds backward to some people, because taxable investing feels simple, it feels accessible, it feels like why not just invest there first? Here's why. Taxes. Tax drag. When you invest in a taxable account, the IRS can take a cut of your dividends, your interest, your capital gains, not once, over and over, year after year, and over a working lifetime, that drag can quietly cost you hundreds of thousands of dollars. Same investing habits, same discipline, very different outcome, just because one person used the right account order and the other one didn't. That is why sequence matters so much. This is not just about saving more, it's about keeping more of what you earn, keeping more of what you grow, keeping more of what you sacrifice to build. So let's bring this all together. Here is the order. Build the emergency fund, grab the full employer match, destroy high-interest debt, fund the IRA, use the HSA if you're eligible, go back and max the 401k, then, and only then, move into taxable investing. That is the financial order of operations. That is how you stop playing defense with money and start building something real. And I know some of this sounds boring. The cash reserve, the debt payoff, the tax strategy. It doesn't sound as exciting as finding the next Tesla or buying whatever social media is hyping this week. But boring is not the enemy. Boring is often where the money is. Because wealth is usually not built in one dramatic moment. It's built in sequence. It's built in structure. It's built by doing the right thing in the right order for long enough that the results become impossible to ignore. So, if you feel behind right now, good. This is your moment. Not to panic, not to chase, not to gamble. To get organized. To fix the bucket, to stop the leaks, to build the foundation your future actually needs. Start with the first $1,000, get the employer match, stop the bleeding on the high-interest debt, and take the first boring step, because that boring step may be the one that changes your life. Your future self is going to look back at this moment and be grateful that you finally stopped chasing shiny objects and started building real wealth. You've got this. And if you're serious about changing your financial life, drop a comment and tell me which step you're on right now. And if you want more practical, no-hype money content like this, subscribe, and I'll see you in the next video.